last really big day of liquidity for 2024, and the bond market seems to make a play for a reversal. What does that mean? And what could we expect from here as the calendar turns to 2025? That's what we're going to concern ourselves with as we discuss what happened and how things are lining up for the rest of the week here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we are going to have a look at here is, first off, how last week's holiday aborted week worked out, and then take a look at what we're seeing setting up here for the rest of this week, and put a little context around what could be the catalyst for the turn that's starting to emerge and that we're getting a bit of a flavor for in the bond market after today's session. So here's how the markets did last week. And obviously, there was a big holiday closure for most major markets in the middle there. The Christmas holiday had markets offline for most of the world's major bourses. And then outside of the U.S., there was the extra closure for Boxing Day. So things were very light in terms of the amount of just hours of trading even that went into the results that we're seeing on the screen. But as we can see, the S&P 500 managing a slight uptick, giving stocks a little bit of a respite after the prior week's sell-off. Same thing for the NASDAQ. It's up fractionally. Doesn't obviously claw away its prior week's losses, but manages to steady a little bit last week. The upswell in yields continues. Another week higher for the 10-year, up 2.2%, and for the 2-year, although there things are very modest, just a 0.3% gain this time. Crude oil continues to march to the beat of its own drum. It's at this point stuck in a digestion range for quite some time. Crude oil hasn't really left the sort of 72.50, 66.50 range since essentially the middle of October. And all we really did last week was notch back up toward the top of that range. So not a whole lot going on there, but the story in yields, as it has been, spilling over into precious metals and the dollar. Gold again down, this time 0.5%, and the dollar up against its major counterparts, both the yen and the euro lower. And what we see in Bitcoin is a little bit more modest of a sell-off, but nevertheless a leg down. And what we find here is really just continuation for the most part, at least as far as bonds and the dollar and gold goes, of dynamics that we've seen for some time, and really going all the way back to the shift in expectations that we saw for Federal Reserve monetary policy starting in September, and the various kind of reflections of what that has been across markets. That, of course, sets us up in a very interesting way for what comes next and what the bond market might be telling us as of today. So let's unpack this a little. This is what we've seen from the market's expectations for Fed monetary policy for this coming year. And we can very clearly see how it has evolved. Here is September's Fed meeting. This is where the Fed comes out and says that they're finally starting their rate cut cycle, and they actually start to deliver on it. They, of course, began talking up the incoming rate cut as recently as July. But what we have here is when that actual cut starts to occur. And so we can see here in September, the markets are much more dovish about where monetary policy is going, then they ultimately end up already by November. See here in the big dashed line here, here's November. And in that period of time, we can see there's been a significant shift. To put this in some perspective here, what we have when we look at the sort of end of the cycle, that last point on the September line, when we look at where that ends up, it's 2.78%, whereas where we are now is 3.9. So we are about 112 basis points, or 1% and some change, less dovish at our current setting than we were in September, in terms of where rates are going to end up by the end of next year. And we can see that already by November, the shift was made. We got a little bit more hawkish into the Fed meeting in December, only just a bit. And we've since sort of moderated a little bit. But we can see here from November, all of this has been very clustered and major changes haven't really occurred. So really the last time that there was a major shift in the Fed view here was back in early November. And between mid-September and early November, this massive revaluing of what the Fed is likely to do occurs. Why does that occur? Here's what the Fed says in September. Mind you, the baseline is rates at 5.3, 5.4%. That's the median of the Fed's target range of 5.5 and 5.25, from which they're counting these numbers. So they're saying that in June, they thought we were going to go down from 5.4 to 5.1. That's one rate cut. In September, they say it's going to be 4 rate cuts. So from 5.4 to 4.4. And they deliver half of them. So 50 basis points up front. They then forecast that they're going to do another 100 basis points next year. From 4.4 to 3.4. That's another 1% decline. So 1% down on rates in 2024, 1% down in 2025, and the 2024 tally, they give us in half of it in one shot in September. But by the time they give us this very dovish outlook, we can see what's already occurring with U.S. economic data, not in absolute terms, because that's less relevant to near-term speculation, but in relative terms. Because what gets markets to move isn't data being good or bad necessarily. Is the data as good as expected, better or worse, as bad as expected, worse or better? Because markets at any given moment reflect what is the baseline outlook, give or take. Volatility occurs when markets get something that doesn't line up with the baseline view, and then assets have to change hands in order for portfolios to rebalance to what is the new reality. And so what we have here is, by the time the Fed comes out with this ultra dovish outlook in September, the U.S. economy has started to turn, at least in relative terms. And so this U.S. Economic Surprise Index from Citigroup is already starting to turn up. We've talked before about when this thing convincingly moves through its 20-day moving average, it suggests that the data cycle is turning. And that's not because the 20-day moving average is magical or has some sort of mystical technical powers. No, we're certainly not doing technical analysis on economic indicator or this kind of index. That's not how technical analysis is used, really. You really want to have actual tradable volume behind an instrument that you then do technical analysis on. Only then is it really that meaningful. No, instead, what we're saying here is this is a daily index that's published every trading day, so about 5 a week. So 20 days is about a month's worth. And then we consider this is relative to expectations. So as analysts that are looking at economic data say, you know what? The data keeps outperforming relative to our forecasts or underperforming relative to our forecasts. Maybe our forecasts are wrong. Maybe we need to retune our models. And since most economic data is on about a month-long cycle, some is quarterly like GDP, some is weekly like jobless claims, but most economic data comes out once a month. Once you get through the approximately 1 month average of what the trend is, you get the sense that maybe these analysts are starting to turn the dials, that they've seen enough data over the course of a month-long cycle plus to say, we need to adjust our expectations. So when you get a prolonged period like we see here of data underperforming relative to forecasts, 0 would be squarely on forecast. And incidentally, after you get that long slide into underperformance from mid-April going into the second half, this is where the market starts wanting the Fed to be dovish. But of course, once the Fed actually delivers the dovishness that the markets want, by then, the ship has already turned. Things are already starting to correct the other way. So what happens here? This is the market, by the way, since mid-April wanting the Fed to be dovish. There it is. Inflation expectations, so-called break-even rates, baked into the bond market going into September's move are trending down. Bond yields, both the 2 and 10-year, are trending down. The dollar is trending down. That is to say, the markets want lower interest rates from the Fed, and they're expecting that the economic cycle cooling will compel them. That's this right here. But by the time the Fed makes good, things are already turning. And we're through the 20-day moving average, and we're starting to find our way higher, suggesting now the data is going to start improving relative to forecasts, and there it keeps going. As it tends to, again, when the 20-day moving average is crossed in a lasting way. So, what do we end up with? As soon as the Fed makes this announcement, the market goes, well, since the economy is improving when you've given us this, again, in relative terms, now that you've given us this dovish forecast, you're going to have to walk it back because actually we don't need that many rate cuts. And so inflation expectations are going higher because we think that the dovish Fed and the chipper economy is going to end up with more inflation. The dollar comes up because all of this implies the Fed does fewer rate cuts because yields are going higher. So all of this is telling us, we're doing the opposite of whatever this was, because now the Fed has given us exactly what we thought we wanted here, but by here, we don't want it anymore. Because by early September, this is already occurring. So, once all of this occurs, and once the market gives the Fed this signaling, what happens in December? Well, by then, the Fed delivers for 2024. It gave us that 50 basis points up front in September, gave us another 25 basis points for 75 total in November. And then in December, it finishes. But then for next year, notice, the outlook is much more modest. No longer are we looking for 100 basis points. We're looking for 50. We're looking for half. And notice what was supposed to be the year-end rate next year now has been pushed forward to be the year-end rate in 2026. Now we're looking at only 50 basis points here and another 50 basis points here. So this whole change has been extended out by a year. and made more gradual, made to arrive slower. As for the markets, they're even less dovish than the Fed. Here's, by the way, that shift from September in expectations for next year and for 2026. And we can see now we're barely looking for 2 cuts over the entire 2 years. The Fed, incidentally, is looking for 100, right? From 4.4 to 3.4 over the next 2 years. The market is only at 58 basis points. And for next year, they're lighter than the 2 cuts that the Fed has, only 44 basis points. So the market has shifted to quite the hawkish setting. They are more hawkish than the Fed's own forecast here. And this, naturally, raises an important question. Because what we then have to contend with as we consider next steps is where we are in the cycle now. Now, to be sure, the U.S. economy is looking very strong, so that there was an adjustment from the Fed's more dovish disposition in September. That certainly makes sense, and the markets didn't go on a 2-month readjustment for no reason. Clearly, the U.S. economy is performing very strongly. We can see here from the latest PMI numbers that a booming service sector is powering the U.S. economy in a very robust way. We're looking at the strongest growth we'd seen since sort of the early stages of this cool down from the COVID catch-up. You can see these were obviously very heady growth levels because we're just in early 2021 here. So we're coming out of the pandemic. We're turning the economy back on, and things are absolutely roaring. As ever, what the PMIs measure is not just growth, but the speed with which it is occurring. So 50 is neutral, above 50 is growth, and the further you go above 50, the faster the growth. Below 50, of course, is contraction, and the further you go below 50, the faster the contraction. So this is not only a sense of whether we're growing, but also how fast. So when we look at this composite index, the reference points for it are back here in sort of latter part of 2021, early part of 2022. That's maybe about halfway into the adjustment that is the cool down after the COVID catch-up. We can see here the pace here in early 2021 absolutely off the charts because the economy was completely closed, and so when we turned it back on, the speed of catch-up was rapid. So it's not just growth, but very fast growth. And then, of course, things cooled off in terms of pace. But we are now looking at still a very healthy level of expansion overall. And indeed, if we look at the Atlanta Fed GDP now forecast, nowcast, we're still tracking north of 3%, about 3.1% for the fourth quarter for GDP growth, which, needless to say, is very impressive for an economy the size of the U.S. and suggests that the very strong momentum we had last year continues. But again, these things matter in relative terms. Take a look at what's going on here with this index, and we can see that while the September FOMC happens at a time when the Fed gets dovish into an upturn for economic performance, which is what gives the sort of counterintuitive response, the Fed cuts and bonds sell off and yields rally. Here we have the flip side. The Fed gets hawkish as relative performance cools. This is where the Fed gets hawkish. By then, notice we're through the 20-day moving average in the opposite direction. And so now it looks like maybe the bond market is too weak like maybe this move has run its course back up at these levels, much like this move ran its course when this policy shift occurred. And so one opportunity we're going to get even this week, bridged though it is, to get a sense of whether the market is indeed looking at it this way is going to be the manufacturing ISM survey. This is a version of PMI-like data from the Institute of Supply Management. The service sector component is coming next week, but later this week we're going to get the manufacturing side. And what we're looking at here is another modest contraction, 48.3 on the index. But what the number is ultimately not that important. What's important is whether it'll be higher or lower than expected. And if what we're seeing here is increasingly a cooling off in outperformance for U.S. economic data, then we should come in line or even a touch lower than expected. And if that occurs, then perhaps what we've seen in the adjustment toward reflation in this move here has run its course. And when we look at what the bond market then does today, what we find is a key reversal, a sharp bullish engulfing candlestick pattern squarely at the lows that we set when we first started to shift in a more dovish direction again back in April, when we started doing all of this and all of this. And so what we could be looking at here is now a bottom with some scope to correct higher. Now, we are still narrowly within this range, but the shape of the price action suggests that perhaps going into 2025, even as the market is hopped up on a strong economy and a Fed that's seemingly moving into a much more hawkish setting, to actually the flip side, much as we did in mid-September, where the market finds it's overcorrected and bonds look poised to bounce, the dollar looks poised to correct lower, and a broader rethink of just how hawkish the Fed is going to be next year comes as a kind of inverse of the rethink that followed September. And that is Macro Money for today. This will be our last show for 2024. We come back after the holiday on Thursday of this week for the first show of 2025. I wish everybody a safe and happy holiday. However you happen to be celebrating it, happy trading. Macro Money is back next year. Take care.